Okay, you guys, we're now going to begin work in Chapter 5, which deals with revenue recognition and profitability analysis. Now, if you remember back in financial accounting, I always used to hammer in, we'll record revenue when it's earned. And that's still the case. They're just going to go into some more detail in this chapter. If you turn to page 232, they go through core revenue recognition principle, and they say companies recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for those goods or services. Notice they don't have to receive it that day. It could be recognized in an account receivable. The 5 steps used to apply the principle. First, you'd want to identify the contract with a customer. Identify the performance obligation or obligations in the contract. Number 3, determine the transaction price. Number 4, allocate the transaction price to each performance obligation. So if you have to perform over a period of time or perform several tasks, allocate a portion to of the revenue to each task or time period. Step 5, recognize revenue when or as each performance obligation is satisfied. And that goes along fairly well with when it's earned, I believe. Some steps, some considerations on top of page 234 in illustration 5.2 when applying the 5 steps to revenue recognition. In identifying the contract, you want to know the legal rights of the seller. You want to establish the legal rights of the seller and the customer. In identifying the performance obligations, if there's a single obligation, we want to know what that is. If there's multiple obligations, we would want to know what they are. Step 3, determine the transaction price, the amount the seller is entitled to receive from the customer. Step 4, allocate the transaction price. Well, if there's a single act to be performed or a good to be transferred, then we don't have to allocate the transaction price among different obligations. But if there are multiple obligations, we allocate a portion of the revenue to each of those. And then step 5, recognize revenue when each performance obligation is satisfied. If there's a single performance obligation, we could either do it at a single point in time if there's one obligation or over a period of time, or at whatever time is appropriate for each performance obligation. So recognizing revenue at a single point in time on page 234. It says, in this case, we want to recognize revenue when control has been transferred to the customer. And illustration 5.3 says the customer is more likely to control a good or service if the customer has an obligation to pay the seller, legal title to the asset, along with physical possession of the asset. They've assumed the risk and rewards of ownership and accepted the asset. All right, now over a period of time, sometimes we recognize revenue over a period of time, and revenue is recognized over time if either the customer consumes the benefit of the seller's work as it's performed, as when a company provides cleaning services to a customer for a period of time. That's going to come into play in this first one. We're going to work exercise 5.2. The customer controls the asset as it's created, like when a contractor builds an extension onto an existing building, or the seller is creating an asset that has no alternative use to the seller. The seller could not use it themselves or sell it to anyone else. It's kind of unique. And the seller has legal right to receive payment for progress due through this date. Such as when a company manufactures a custom jet for the U.S. Air Force. Can't very well sell that to Joe on the street, right? Okay, so let's look at first, we're going to do exercise 5.2, and then we're going to go into some where we're dealing with some long-term contracts. Okay, so on exercise 5.2, pages 281 and 282, Let's read through it first. Ski West Incorporated operates a downhill ski area near Lake Tahoe, California. An all-day adult lift ticket can be purchased for $85. Adult customers can also purchase a season pass that entitles the pass holder to ski any day during the season, which typically runs December 1st through April 30th. Ski West expects its season pass holders to use their passes equally through the season, and they're assuming that, okay, and then the company's fiscal year ends on December 31st. On November 6th, 2016, Jake Lawson purchased a season pass for $450. All right, number one, when should Ski West recognize revenue from the sale of the season pass? Well, they received the cash on November 6th, but they're going to earn it equally in the months of December, January, February, March, and April over those 5 months. So they would want to recognize the revenue over those 5 months. So here we go, you guys. Ski West should recognize revenue over the ski season. Ski West fulfills its performance obligation over time as it delivers the service to its pass holders by providing access to the ski lifts in the months of December through April. Okay, so they should not recognize any revenue in November, but a portion of the revenue in December, a portion in January, February, March, and April. Okay, next, on number 2, they say prepare the appropriate journal entries that Ski West would record on November 6th and December 31st. So we'll start, of course, with November 6th. Got kind of a wide column for my date there, but that'll work. Okay, so on November 6th, we now have more cash as the customer, Jake Lawson, paid us. So we'll debit cash to increase its balance, $450. We can't record the revenue yet, though. In our financial accounting book, we call it unearned revenue or unearned rent. In this book, I believe they call it deferred revenue. It's just two names for the same thing. You could use unearned revenue if you'd like. $450. Okay, now they also want the journal entries on December 31st, their year end. Okay, well now they will have earned a portion of the revenue. They're going to earn it over 5 months, December, January, February, March, and April. By December 31st, they've only earned 1/5 of it, though, or 1 month. So we're going to debit deferred revenue, the liability, to decrease its balance. By $450 divided by 5, or $90. And then we'll credit the book. Your book uses service revenue, so that's what I'll go with for $90 as well. That's just the amount earned by the end of the year. All of the $450 would be in service revenue by the end of April. Okay, number 3. What will be included in the Ski West 2016 income statement and balance sheet related to the sale of the season pass to Jake Lawson? Okay, you guys, the $90 is included as revenue in Ski West 2016 income statement. We recorded that here as service revenue in an adjusting entry on December 31st, their fiscal year end. In the $360 remaining balance in deferred revenue, see, we had a $450 balance in deferred revenue. It was decreased with the debit for $90. So we have a remaining balance of $360 in deferred revenue, and that's included in the current liability section of Ski West 2016 balance sheet. Now, after watching this one, and working it with me, I don't think you'll have any trouble with the one on the Connect Plus site. If you do, please let me know. Thanks a lot.